Canada is committed to phasing out fossil fuel subsidies by 2030. So I'm going to talk to Rachel Samson, who's co-author of Cutting to the Chase on Fossil Fuel Subsidies, and she's the Director of Clean Growth at the Canadian Institute for Climate Choices. Welcome to the interview, Rachel.
Hi, Mark.
Well, look, can you start, maybe give us a brief overview of the study, please?
So what we did was we took a different approach to assessing fossil fuel subsidies than what we've seen in other reports. We took a selection of government measures, federal and provincial, and we assessed them on a different set of criteria, 4 criteria that reflect not only climate objectives, but economic and societal objectives as well. And what this does is it provides a more practical approach to considering the scope of commitments to phase out fossil fuel subsidies and how to do it in a way that really supports economic growth and employment outcomes as well.
Now, you've got 4 criteria here: consistency with low carbon transition, value for money, employment outcomes, policy fit. And because I do a lot of work in oil and gas and the energy transition, this is of interest to me because I think of the oil sands, which recently asked the federal government for $50 billion as part of its decarbonization initiative. And the studies have shown that over time, over the next 5 to 10 years, maybe 15 years, employment is going to continue dropping significantly, maybe by a third. So we're in a situation where the federal government could put $50 billion into an industry that probably will cut its employment by a third. That doesn't seem like a good use of good value for money for the public investment.
And that's one of the reasons why we recommend that governments develop a clear framework for investing in emission reductions. So particularly given that they are so capital intensive, we're talking about billions of dollars that are going to be expended. So, it's not just about the emission reductions associated with the project relative to some historical level. It's really thinking about our economic objectives as well. How do we improve the resilience of our economy to global market change? How do we ensure that our workforce is becoming more resilient to that change as well? And within that context, governments could consider where that money is best placed in order to maximize those outcomes.
That's right. I think that's an important point, is that everyone's competing for scarce public resources. The Canadian Treasury is not unlimited in terms of what it can do to support this. And there are plenty of other sectors that are growing employment, are important to the energy transition, and lower emissions.
Yeah, and there's a risk to treasuries as well through global low carbon transition, given their reliance on revenues from transition vulnerable sectors that really, when governments are investing, they need to think about how to generate that economic growth that's going to really provide that fiscal stability going forward as well.
I have a question for you that is not directly related to your study, but certainly is indirectly. And that is, I interviewed your colleague, Jason Dion, about his decarbonization pathways study, where he modeled various technologies and came up with 60 potential decarbonization pathways. And one of the things that struck me, and especially as I do work with the US academics and so on about their energy transition, is the Americans model a lot of this stuff. They do economic modeling, and Canada doesn't do nearly enough. And so to answer some of these questions, you almost need to do the modeling first before you undertake the policy. And it strikes me that we don't do enough, and I'd like to get your opinion on that.
Well, our report, so building off of Jason's report, we released a report in the fall called Sink or Swim, where we did model, publicly traded companies, Canadian publicly traded companies, based on their assets and their sales. How profitable would they be through a global low carbon transition? So we have a pretty good sense of the vulnerabilities and risks facing Canadian companies. And some of the arguments are, well, these global scenarios may not play out. And of course, we can't predict exactly how markets will change, particularly over the coming decade. But when we look long term, we look at the coming 3 decades, it really is inevitable that global oil and gas demand is going to decline. We're now in a position where countries representing 90% of global GDP have committed to net zero goals by mid-century. So, even if they don't fully hit their targets, we're still talking about pretty dramatic changes in global markets.
Right, and that seems to be a very sensible policy approach to this. Do the modeling, understand what the potential scenarios are and the impact on your, the Canadian fossil fuel industries. And I guess here we're really talking oil and gas because coal is going to be phased out by 2030. So do the modeling, then have criteria for application of fossil fuel subsidies. That seems like a very rational approach to me, as opposed to the way we sometimes do it here in Canada, which is basically we're responding to industry lobbyists or industry public pressure to put a policy in place.
Well, there's this argument that we need these subsidies in place in order to support growth and jobs in those regions. And what our analysis shows is that oil and gas production, and I would add metallurgical coal to that because there's still a lot of focus on metallurgical coal mining as well, that those really aren't the secure, low risk sources of growth and jobs that they used to be. When we're looking at the coming decade, that risk is just going to grow. And governments would be better placed to make investments in other sectors where global markets are growing and there are massive opportunities.
And there's another variable in here, and I guess maybe this comes under your value for money criteria. When we look at oil and gas, the profits over the last year or two are just, I think we're getting to windfall profit territory. And I've interviewed Wood Mackenzie on this a couple of times. They argue that because of underinvestment in exploration and production, prices are likely to remain high all through this decade. This is probably going to be the last big oil boom that the world sees. And so the industry is flush with cash. And so why would we put a lot of public money into an industry that can, for the most part, finance its own energy transition?
And that's one of the things we recommend as well. Let's first adjust carbon pricing and regulations to provide additional incentives for private investment in decarbonization and also in pivoting into new business lines that are more transition consistent, and then look at what additional public support is needed so that you're not first relying on public funds or foregone revenue as your solution.
Yeah, and there's another point that is often ignored in this discussion, and that is that under industrial emitter programs, and certainly the case in Alberta, where most of the oil production takes place, under the output-based pricing system, they get 80 to 90% discount on the carbon price. So the carbon price is $50 a ton. They're paying maybe 10% of that. In fact, I think the figure I saw the other day was that Suncor, one of Canada's biggest oil and gas companies, paid about $2.50. It's paying 5% of the actual carbon tax. And so why not tighten up those regulations before we, go and spend a bunch of more public money on these industries?
Yeah, and there's arguments kind of on both sides, right? The industry is saying that they're going to be competitive through low carbon transition, that they have very strong balance sheets and they're going to be fine, but at the same time arguing that adjusting carbon pricing is going to make them not competitive. So that there's a disconnect there between those two arguments. If they have strong balance sheets, if they are in a good position, then they can afford to invest some more in decarbonizing their operations.
That's right. And getting back to modeling, I mean, I know all of the big companies, the Suncors and the CNRLs and Cenovus's and Imperial Oil, they all model out to 2050. And I've interviewed some of those executives and they say, well, we think that our best interests are served, the company's best interests are served, not by investing in low carbon businesses or, renewables, that sort of thing, but simply by decarbonizing our existing assets. Well, I'd like to see that modeling. because it's all based on assumptions. And, we have to take their word for what the conclusions are, but we don't get, other economists aren't able to source their data and look at their assumptions and comment on those. And that seems to me, again, another part of this, this disconnect in the public conversation about fossil fuel subsidies is that the government gets, lobbied on that basis, but we don't get to see the data.
Yeah, and there's so many considerations around, even from a company perspective, where it makes sense to invest. What's the remaining life of the asset? What are the break-even costs associated with production? And then from that, you can figure out, well, what really does have a chance of remaining competitive? Where is that investment worth it in terms of oil and gas production? But we also really want to see these companies investing in future opportunities in markets globally where we're going to see increasing demand. And from a worker perspective, where we want to be generating the jobs in order to improve that resilience.
I couldn't agree more. And if you look at what's happening in Europe, the super majors there, like the BPs and the Equinors and Shell, are investing in all sorts of low carbon businesses, startups, and buying existing electrical utilities, that sort of thing. In Canada, Suncor is the only one that's doing that, and they're not doing it to much of an extent. They're doing it. There's some, and they should be, applauded for that. But the other three big companies are not, and have no real intention of doing it. And that, yet the industry will say publicly, as Mark Little, the Suncor CEO, says, we're generating enough cash, we can drive the energy transition by investing in energy transition businesses, and then they don't do it. And then they ask for subsidies. So all of this needs to be put on the table, and I can see where your framework and combined with modeling would tease out some of those complexities that we need in the conversation around this.
And there may be more of a justification for government intervention in some of these newer markets where there is uncertainty. The demand trajectory is not as clear. Some of the technologies do carry some risk associated with them, large upfront capital investments. So government intervention in that sense would make more sense than focusing on decarbonizing oil and gas production, in particular oil and gas production that is high cost.
Well, Rachel, thank you very much for this. Really appreciate your insights.
Great. Thank you, Mark.